Welcome back. So in this lesson, we shall try and understand something about the primary market and the secondary market. So in the previous lessons so far, we have seen that the company called FFGL, they took money from the public by offering them shares of their own company and making the public shareholders in that company. Alright. So as public or as member of the public, if you want to buy shares of a company, then probably you have got two different avenues. One is that you can buy shares directly from the company. Company are the primary issuers of the shares, and when you buy it directly from the company, then it is called as the primary market. Now, this primary market, or you can buy shares directly from the company only when the company is offering the shares through their IPO or FPO, or at times through bonus shares or the rights issues. Now, this does not happen all the time or every day. It is only occasionally when the company would offer shares directly to the public. What about rest of the time? At other times, you can buy shares from someone who is already having and wants to sell those shares. Now, once the company has sold the shares to the public, then the public among themselves would want to buy and sell the shares. That is called as the secondary market, and that happens through the stock exchange. All right. Another difference which you must try and understand is that in a primary market, or when you are directly buying shares from the company, the buyer and the seller are known to each other. See, I have shown known in inverted commas. What does it mean? It does not mean personally known as friends or relatives. It is that when you are making an application to a company for buying shares, you know to which company you are making an application, and the company on receiving the application knows to whom they are issuing the shares. So to that extent, the buyer and the seller know each other. But in a secondary market, when you are buying shares through the stock exchange, there the buyer and the seller do not know each other. The buyer would place a buy order on the stock exchange through the broker. The seller would also place a sell order on the same stock exchange through another broker probably. And then the exchange software will automatically match the buyers and the sellers. And if the buy price and the sell price are matching each other, then the trade gets executed. The buyer and the seller would not come to know each other. The buyer would not know who has sold the shares to him, and the seller would not know who has purchased the shares from him. So try and understand the conceptual difference between a primary market and a secondary market. Now let us try and understand how shares are purchased in a primary market. That is quite simple. Now let us say a company is offering 1.8 million shares either through their IPO or the FPO. Alright. And each share, as we discussed earlier, is having a face value of $10 or 10 rupees or reals or whatever. Don't worry about the currency or whichever country you are in. The conceptual thing remains the same. Alright. So let us say that each share is having a face value of $10 and a premium of $25. Why premium? We have discussed earlier, because the company is already running and making profits. So therefore, they have some reserves, and that is why they are giving or offering shares at a premium. So therefore, the offer price becomes $35 per share. Alright, $10 as the face value, $25 as the premium. So $35 is the offer price. And the minimum application size, let us say the company has fixed that one has to apply for a minimum of 15 shares. Alright. So the application money becomes 35 multiplied by 15, that is $525. So anybody, by making an application and putting in $525 minimum, can purchase shares of that company. And now this offer which the company is making, the IPO or the FPO, that would normally remain open for 3 days. So within that 3 days period, people have to make applications. Alright. So people will make online application through various websites or platforms or through the brokers, and the application money is blocked. The application money which they give, for every 15 shares they will have to pay an amount of $525. That money does not go into the account of the company or the sellers of the shares. The money only remains blocked in the account. Alright. And then let us say that the company gets valid applications for 18 million shares against an offer of 1.8 million. So if that be so, then the issue is said to have been oversubscribed by 10 times. The company was wanting to offer only 1.8 million shares, but applications have come for 18 million shares. So 10 times oversubscription. What would the company do now? The government permits the company to increase the offer size by some percentage, but not this much. Let us presume that the company is not increasing their offer. They keep it at 1.8 million only. Alright. So now since the issue is oversubscribed, the company would make proportionate allotment. Alright. Those who have made application for 150 shares probably will get maybe only 15 shares, or in different forms by different methods the company would proportionately allot the shares, the minimum quantity being 15 shares. Alright. Sometimes the company may draw a lottery also, and based on that they may give shares to the subscribers. And then once the company issues the shares, they would realize the proportionate payment. For example, if somebody has made an application for 150 shares, but they are getting only 15 shares. So the money for the 15 shares will be realized, and the balance of money that the company will release, which was blocked, that money would be released. And so the public who had, blocked that money, they are free to use that money now. Got the point? And then the shares get credited to the buyer's demat account. The company retains the money, whatever shares they are allotting, and the shares are credited into the buyer's demat account. And then in the next couple of days, the shares are listed on the stock exchange, and now they are available for trading freely in the secondary market. Got the point now? The company has issued the shares to the public. After 3 days, once the company has made the distribution, they are no more giving shares to the public directly. Now the public among themselves can buy and sell shares depending upon the price which they perceive. Alright. So that is the secondary market. And now since the issue is oversubscribed almost 10 times or more than 10 times, then it may get listed at a much higher price than the offer price. You see, the offer price was $35 per share, but since there is a huge demand, 10 times people have asked for that, or 10 times people want those shares, it may get listed at a much higher price than the offer price. Alright. So now, in the next lesson, we shall see how the shares are traded in the secondary market. Alright.